So thank Alan for the intro and putting this together. Alan certainly does a good job of vetting the companies that he brings to the table, so we're lucky to be included in that group. Kush bottles traded on the OTC under the symbol KSHB. Company was founded in 2010. I am one of the co-founders, and I'm currently the CEO of the company as well. Little disclaimer slide. They can read fast. All right, we'll talk a little bit about the industry overview. So, looking at the cannabis industry, I mean, we'll go kind of quickly through that because we're at a cannabis-focused event. So most of you guys are familiar with the projections that are out there, different data that people put forward, and what they expect from cannabis. I think it's a bit of a moving target because it's dependent on when these states actually get their regulations in place. California being the biggest driver. Some people say it's about a $10 billion market. It could be as big as 15 billion, I believe. And some of that depends on pricing and what happens there. And that's a whole different debate. But in terms of when they get the regulations rolled out, they're expecting, or hoping for January. Some people think it might be July. We were lucky enough to have our president, Ben Wu, appointed to the 25-member advisory committee for the BCC, Bureau of Cannabis Control here in California. He'll be participating in the rulemaking process. That was announced about a week ago. So very soon we should have better insight of kind of the true timing to that market, but that's a big catalyst to drive these numbers. We can go to the next slide. Going along with that, federal and state initiatives really, I think, for all intents and purposes, is going to be the state initiatives that is driving the industry forward here in the next, 4 to 5 year period at least. And that's great because that gives companies like us an opportunity to operate without a whole lot of competitors coming in because of the federal illegality. It gives us an opportunity to expand into all the new states that come online, but not be forced or sped up in our expansion and required to be in every single state all at once. We can really focus a little bit more and use our resources wisely and be in California, Nevada, Massachusetts, Florida, some of these key states, and not get spread out all over the place. Shifting public opinion, that's kind of the big thing. And when we look at, this industry moving forward and certainly not going backward, the amount of people supporting it now, we have up to almost 60% supporting adult use recreational cannabis. We have almost 100%, it's about 96, 97% supporting medical cannabis. And we have some protections in place for medical cannabis under the Rohrabacher Amendment, and we expect that to stay in place. So there's really some posturing from the federal government, but realistically, there's not a whole lot they can do. They don't have the resources to truly move the industry backward. They could slow it down, but we know with the public opinion in place, it's only a matter of time before it becomes federally legal. Taking a quick look at our company at a high level, we have a division that's our core division, which is our B2B. So what we are is we're a business-to-business supplier of cannabis packaging, different accessories for the industry, everything from child-resistant packaging, branding, so custom branded packaging, branded bags, things like that, all the way down to accessories like glass pipes, lighters, grinders, and then by way of acquisition, now we're one of the largest distributors of vape cartridges and vapor hardware. So again, we're all on the ancillary side, sort of like the picks and shovels for the gold rush, and we're selling these products directly to the cannabis businesses, whether it's the cannabis cultivators or growers, whether it's the processors, edible manufacturers, oil makers, or whether it's the retailers or dispensary storefronts. That's our core business, and we have facilities in 3 states that we own and operate, and we have exclusive distribution agreements in another 3 areas, Puerto Rico, Hawaii, and Alaska, some of the remote areas. We have a facility in Denver, 1 in Seattle area, and 2 in California. Our B2C side of our business is small. We got into it via acquisition of Rollable, so we took over that product, which is a proprietary product, but it came with a consumer website that has about 40,000 unique visitors a month, and so we monetize that product direct to consumer as well as do a little bit of an online smoke shop, but it's not a core part of our business. And then the third element is the brands and IP. So we know that long term, to be sustainable in the marketplace, we're going to have to build out a portfolio of branded products or products that are proprietary, protected with IP, and that are exclusive and unique to Kush bottles. So we've begun to do that, and there's a slide in here where we'll show the progress we've made so far. Looking deeper dive into the B2B side of our business, we have Kush Bottles, which has primarily been a packaging provider and some other accessories, but really made a stake on the industry with certified child-resistant packaging very early on. Now we've seen some of the regulations start to catch up with some of the stuff we've been pushing since early 2010. And we have, now California, which is obviously the biggest market in cannabis. The state alone is bigger than the entire market as it exists today. Finally, for the first time, requiring child-resistant packaging for every product sold when that regulation comes out. Again, we're part of that rulemaking process, so we're going to be in tune with when that's all happening. But it's a huge catalyst for us. We saw in Colorado, in calendar year 13, our sales were about $30,000 tops. In calendar year 14, we sold over $1 million of product in the state of Colorado, all because of this child-resistant requirement and the opening up of the adult use market there. And that's now coming to California, which has been medical since '96, but never had any regulation around packaging. In fact, we still compete in the market today against Ziploc bags or other, non-compliant forms of packaging. So that's huge for the packaging side of our business. And again, we also do custom branding. We have in-house graphic designers that can actually make these packages look really unique, really vibrant, bright, stand out on the shelf, really exemplify people's brands. And so when you're in a marketplace like California, where it's all of a sudden shifting and people are needing to build brands, and these are now growers and farmers that have never thought about marketing, have never thought about branding, and all of a sudden they need to prepackage their product and create a brand that stands out on the shelf. Working with someone like Kush Bottles that understands the regulation and what they need to comply with, and also the branding and how you need to really identify and stand out on the shelf, is a real huge value add for a lot of these farmers that just simply don't have that experience, and we can really help make that transition for them. And then our acquisition of CMP Wellness, we acquired them on May 1st, so just a few months ago. We reported our third quarter, which only had 1 month of financials that included the combined entities of Kush Bottles and CMP Wellness. Our fourth quarter, which we have yet to report, will be our first full quarter of the combined entities. We disclosed a pro forma with CMP Wellness. It basically shows that when we purchased them, they were, almost on par with the same amount of revenue that we were doing as a company, so effectively almost doubled our revenue. And again, we've only disclosed 1 month of the combined entities, so that's still to come. CMP Wellness is one of the leaders for vaporizer distribution, so they work with a lot of the big companies that you hear about here in California, Brass Knuckles, Moxie, Clear, doing all their vape cartridges for them. And we have a big book of business that we inherited with which didn't have a whole lot of crossover, which was bad in one sense because we should have been selling to those guys, but it's good in another sense because now we have an opportunity to cross-sell. So we now have a whole new book of business that was buying vape cartridges that was not buying packaging. And we have a whole book of packaging clients that we've been servicing throughout the country that weren't buying their vape cartridges from us. So this integration of this acquisition is going to be huge, not just leveraging the existing revenues, but really upselling and cross-selling across the client book to leverage and unlock new possibilities in terms of revenue and product segments that we're able to penetrate to the marketplace. Our B2C side of our business, we have a couple meaningful things here. Really, the rollable is the acquisition we did on May 5th, and that is a proprietary product that goes through our B2B channels, but like I mentioned, also has a B2C element, and we own and operate rollable.com. Terpsonterps.com is a terpene marketplace, and this is about education and about getting some ancillary products that aren't just hardware, but actual oils that, again, no THC, no CBD and terpenes, but we're selling them to the same clientele that's buying vaporizers and cartridges from us. So there's an opportunity there. It's pretty new for our business, but there's a big opportunity. And then Midnight Toke is a online glass smoke shop. So we know that that's a market that other folks have penetrated well. And so I think there's an opportunity, since we already source a lot of those products for the B2B side of our business, for us to potentially dedicate some resources to push those products directly to consumers. As I mentioned, we've been trying to build out our brands and intellectual property. We know that long-term that's going to make our business very sustainable in the marketplace. We have some products here that we've been able to either brand, patent, or acquire through acquisition, or launch in a proprietary fashion. So, for example, the Kush canister is a product we recently launched to package large format cannabis, so edibles, larger quantities. It uses our manufacturer's IP on the child-resistant locking mechanism. Our manufacturer defends that IP, their IP, with over $1 million a year. And we have exclusive rights to this product because we built the product together with them, leveraging their IP. So it's an example of how we can get proprietary products. The Snap Cap tube, we got a patent granted recently this year, and that was for the customizable feature on that tube. So again, going to R&D, being able to develop our own products is going to be a strategy we're going to look to push going forward. And then branding products. So Bud Gloves is a good example of that. It's a product that exists in the marketplace. It's just your standard black nitro powderless glove. Every grow house uses it. A lot of dispensaries use it for handling cannabis. And rather than just selling a generic product, we went ahead and built a brand around it. Bud Gloves, again, exclusive to Kush bottles, sort of like a Kleenex play there, where you can actually create a brand that the market knows, understands, and asks for, and there's only one place that they can get it. This slide looks at our reach that we have. As I mentioned, we have 4 facilities that we own and operate, 3 exclusive distributors in the remote territories. It's a strategy we're going to use for the remote areas where it's very costly to ship, but the market's not quite big enough for us to spend our own resources to be there. So our facilities, again, California, 2 in California. The one in LA we received by acquisition of CMP Wellness, 1 outside of Seattle area, 1 in Denver, and then our exclusive partners are in Alaska, Hawaii, and Puerto Rico. So we have a pretty good footprint in the green areas where the high volumes of cannabis are being sold right now. And we can get product to our clients very efficiently. About 80% of our clientele, we can ship product 1 or 2 day ground for no additional charge. So it's a huge value add on a new market when there's a lot of new players that don't, the market's evolving, they're evolving, and so it's hard to forecast. It's hard to always know what they need to be purchasing. So when we have product in stock in a local geography that we can actually ship to them efficiently, it becomes a huge value add, and we end up picking up a lot of clients that we're working with a broker that simply can't afford those lead times to get their product shipped in from Asia. We have it in the States, and we have it available for them. We have an evangelical sales force that's actually out on the ground in these markets. So not only in the markets where we have facilities, but we have sales staff in Oregon, we have sales staff in Nevada that are on the ground interfacing with clients. And we believe this is extremely important in a new marketplace because cannabis is evolving very rapidly. When we were starting the company in 2010, 2011, the market was 95% flower, and the other 5% was edibles in the form of brownies and cookies. Now you look at a dispensary, obviously the shelf is very vast. You have all sorts of different edible products. You have all sorts of different concentrate products. And how you package all these different products, how you display them, the different hardware that you need to consume them, it's very dynamic. It's evolving. And so when we're actually out there on the ground, we can have these conversations with our clients and really better understand their business and then allow us to better help them with our product and our services that we offer. So having those boots on the ground is a key advantage, and we're one of the only companies in the space that actually focuses with face-to-face boots on the ground, high-level salespeople. These are 6-figure level salespeople that we put out there. Our broad and diversified client base, we're not selling to one point on the supply chain, right? We're selling to every point on the supply chain. We have products that either are sold to a grower that needs a package, to an oil processor that needs a vape cartridge, or to a retailer that wants to sell additional items at the point of sale to increase their revenue and higher margin items such as glass pipes and things like that, as cannabis margin comes down, these could be huge offsets for a retail outfit, and they're not subject to some of the stringent tax requirements that cannabis is. So we see that being a potentially big growing part of our business as well on the retail side. You look at our growth strategy, it's pretty straightforward. I mean, we look at new products. So if we have an existing book of business, last year was over 4,000 clients that we serviced. All we need to do really is to add new products and additional services that we can offer to that same client base, and we can get growth that way. Another very easy way for us to get growth is to continue to be a first mover in all the new markets. So a lot of our resources right now are being spent in locking down California, which is going to be a huge market. We have resources on the ground in Nevada, which just opened up July 1st. So getting into new markets ahead of the competition with our same products allows for growth. Our strategy is to do those both together, and that's where we really get an aggressive growth plan that we've been executing on and we expect to be able to continue to execute on. And then the other piece, in addition to organic growth, would be growth by acquisition. We've demonstrated that we've done 3 acquisitions already to date. 2 of them were done in May of this year. We have the right team to do it, and we'll talk about that. But more importantly, we have the right situation that's come about as cannabis is a very unique and dynamic situation, has opened an opportunity for a company like us. It's relatively small, but we're one of the few public companies. We can access capital. We're in a market where nobody can access capital. They can't get traditional bank debt. They're having a tough time getting favorable terms with equity investors. And there's a lot of good entrepreneurs that are growing their business very nicely, but they're hitting a roadblock, and that roadblock is typically capital and infrastructure that they don't have access to. We can solve that roadblock for them. We can give them equity. We can structure these deals with a lot of equity upside so that these entrepreneurs aren't taking all their chips off the table, but they're getting the best of both worlds. They're getting the capital they need to grow their business. They're getting an infrastructure and a distribution network that they can plug into, and they're getting the equity upside in the form of a public stock that actually has some liquidity. So it's a real value proposition that's resonating. And as you can see by our big deal with CMP Wellness, we structured it to where it's $21 million up front, $19.5 million was in the form of stock. So the market recognizes value in our equity, and that's the key piece when we're out here pitching acquisitions by way of stock. This is a little bit more about the platform. We have specific departments, for example, accounting. We're a public company, so we have a whole accounting department. We have a whole supply fulfillment supply chain department that's used to ordering a broad range of products. We have over 2,000 SKUs that we offer. So this is huge for companies that that becomes a growing burden, and we can again take that over. IT, marketing, now product development. We're spending allocating a good sized budget to developing new products, and of course our evangelical sales team that's out there pushing products. So this is a nice infrastructure for an acquisition business to plug into and actually leverage for further growth. And again, with our stock as currency, we've done 3 acquisitions today. They've all been very stock heavy, so it's a valuable tool. And now about the leadership team, myself, co-founder and CEO. In 2014, we brought in Ben Wu, who had a private equity background doing M&A activity. He spent 8 years as a VP at Wedbush Capital. He looked at 1,000 businesses a year, all small to mid-sized entrepreneur-ran businesses, and they were doing acquisitions. He was not only vetting the deals, structuring the acquisitions, but also coming in and helping the management teams drive growth. So he's a perfect guy to run our M&A division, and we're lucky to have him on the board, on the team since 2014. Jim, we just recently brought on. Jim McCormick was the CFO for different divisions of British American Tobacco for 15 years. He's got a wealth of experience. He was the CFO of Sodexo Foods, which was a NASDAQ-traded company, and also has some entrepreneurial experience with a company called eSig and a few other ventures. So Jim is pivotal because he's bringing a lot of the larger company experience, where we want to go, but he's also has some of that entrepreneurial zeal and a lot of that scrappiness that fits right into our culture day one. And so we're excited to have him on board. He's only been with the company a few months, but he's integrating really well, and we're very excited about the opportunity for the value that Jim can provide to our business. We'll take a quick look at a financial snapshot. This is from, I believe, our Q3 highlights. And, most notable, the revenue. As Alan mentioned, we have more revenue than most cannabis companies, especially in the public sector. We pride ourselves on consistent year-over-year revenue growth. We've been growing about 100% year-over-year for the last 4 or 5 years. We have a good amount of assets. A lot of those assets are in the form of goodwill from acquisition, but we have about $4 million or so in inventory that we have across our multiple facilities. So something that a competitor coming in trying to compete with us, especially if they're not well funded, how are they going to get that size of infrastructure and that size of inventory to when customers call them, they have it in stock and they don't need to give a 10 or 12 week lead time? It's going to be hard for some of these guys to catch up to us. So working capital is really a competitive advantage. And then gross margin, we're not a low margin business. We're selling, items that can be considered commodities, some of them. But when you add a regulated market, a dynamic marketplace, and the value add services we provide, we're able to actually make that not a low margin business, but a decent margin business. And we expect our margin to remain flat as it sort of has over the last few years. looking at our growth, as I mentioned, 100% year over year. Last quarter, third quarter, we showed 103% from the previous third quarter. Our fiscal year is sort of back end weighted. We start our fiscal year on September 1st. Third quarter, we have 420. Fourth quarter is all the summer months, June, July, August. So typically our year is very back end weighted when it comes to revenue and growth. And so we showed that in the Q3. We have not released Q4 yet, but we need to release Q4 in our 10K by the end of November. So stay tuned. Again, our balance sheet, if you take a lot of these other large companies, Fortune 500 companies, they got a much better balance sheet. You go into the cannabis industry, there's not a lot of people with strong balance sheets. So we have this moat that's been created by the federal illegality. We're taking advantage of it. We're being the big fish in our small pond, and we're going to go out and we're going to aggressively acquire folks by way of acquisition products. We're going to bring on new products. We're going to expand our sales force. We're going to get into new markets, set up shop in new markets, and we can do that with our balance sheet, whereas a lot of our competitors simply can't. And lastly, the key takeaways from the presentation, again, we're dynamic distribution platform. So we're not set in any one thing. We're not, our name's Kush Bottles. The pop top bottle that we started the company with is, almost 5% of our business now. So we're not set in any one product. We're going to be dynamic, whatever's moving, whatever our clients are demanding, whatever we think is innovative and can push the envelope, we're going to carry and we're going to push. We're going to continue to service all points on the supply chain, right? We're going to stay heavy focused on the B2B, which is harder to disrupt with a platform like Amazon that's, disrupting all consumer marketplaces these days. So the B2B, having those relationships, meeting face-to-face, having the understanding of the market, working with the regulators, again, being on these committees, helping create and draft regulation is key when we talk about value that we're providing to the marketplace. We have, again, a team that is capable of making additional acquisitions. We've made a few to date. And due to the environment that's being created by cannabis, we have a unique opportunity where we're able to grow. We're able to be this bigger fish that can make acquisitions, that can raise capital when a lot of our competitors can't. But the real big players are kept out for a certain period of time. So we have this limited window where we're going to push as hard as we can to grow our business, to get as much market share as possible, to continue to grow our revenue. And eventually, when that barrier goes away, hopefully it's in about 5 years, we'll be big enough to where we can stand alone, we can compete against the big boys, or obviously we could be a prime acquisition target for somebody that really wants to get into the market. And that's all I have today. I'll let Alan do the Q&A. Thanks.
I was going to thank you first of all. And, we have time for some questions. And before we do that, though, I wanted to first say something Nick didn't bring up. I meant to bring it up. They are the only U.S. company covered by a Wall Street bank, Cowen Company, which I just checked, they're still covering you. And I think that's a real testament to what the company's doing. It's not easy to be a U.S.-listed cannabis company trading on the OTC, and I think this company does everything it can to step aside from kind of the image that OTC companies have, which is unfortunate. That's the way, if you're familiar, is everybody familiar with the U.S. Public markets? Last time I asked, not everybody was. Is everybody an investor here? Or? Okay, so you know what I'm talking about. And before we get kicking off on some questions from you guys, I just wanted to find out quickly the things I hear about your biggest opportunities in California, obviously. Mm-hmm. But can you explain to everybody, how is California now, and how's it going to be different, and why that's such a big deal for you guys? Yeah, absolutely. Well, number one, California today is only a medical market. There's not a lot of really sound data, but people say 2 billion, maybe it's 3 billion. It's big. It's not a small market today, but it's on the medical side, highly unregulated. So everyone's operating under Proposition 215 for the most part. There's probably, if you look at actual city licenses that have been granted, there's probably, a few hundred. But in terms of people that are operating, it's well in the thousands, probably over 10,000 folks that are operating right now under this Proposition 215, which is a quasi, legal structure. It's the best that, was available for many years, but it's all being reinvented. So under the 215 structure, you're at risk of raid. You're at risk of getting shut down. When you're in that type of environment, you're not going to want to be spending a ton of money on your packaging. You're not going to want to be really reinvesting your money into growth. You're going to want to be taking as much profit as you possibly can because your window and your runway is very short. So in that
existing market, which has been around, again, since 1996, it's a lot harder for a company like us to do business, especially when we're talking about wanting people to be compliant, to be above board, to be branded, to really spend and make their brand stand out on the shelf. So we're looking forward to the new market, which is actually going to allow people to have permits, both at the local and state level. And it's going to be, obviously a little bit more limited. So there'll be less operators, but there's going to be the same amount of demand for cannabis. So in terms of the amount of products sold, it's actually a potentially better environment where we have to focus with less clients and get the same amount of business or more. And again, that's only medical. Now you have adult use opening up as well at some point, right? And that might be delayed a little bit, but it will come online. And we saw in Colorado about a 20 times increase in the amount of cannabis purchased when it went from medical to adult use. Will California be 20 times? I don't know. I think some people say, well, it's easier to access medical in California, which is true. But on the other hand, we have 5 times the amount of tourists that Colorado has. We have almost 250 million tourists, a lot of them coming from the eastern part of the world, which has no access to cannabis whatsoever. So I think we could see somewhere between a 10 on the low end to 20 times increase in the amount of cannabis consumed, all in a licensed framework environment, all with requirements around what products you're using for your packaging. When you have a license that you spent millions of dollars to get, you want products that you know are going to work, vaporizers that aren't going to blow up, companies that have insurance that can lend that to you so that you can feel safe. It plays really well into our model. And again, we're helping kind of regulate the marketplace. So, hopefully we can regulate it in a way that makes sense for everybody, but certainly positions us well.
Questions? Go ahead, Barbara.
I've seen that basically your accounts receivable was growing, and you acquired to basically use stocks, not to cash, right? So how do you service your basically working capital requirements as they grow,
Yeah.
right?
So good and bad, right? When you go from this black market to the legal market, you get higher class operators, which is good. On the other hand, these are more sophisticated operators that are used to dealing in business where they are afforded terms. And so they come to a provider like us and they want terms. Now, a lot of these people can be vetted, so we can verify that we're going to get paid eventually. And we are lending more terms, and that's why you're seeing that accounts receivable go up. And that's going to be a continued thing, obviously within moderation and reason. We're going to be monitoring, but that's just the nature of the marketplace. On the other hand, right, as the marketplace evolves, companies like us don't have as much stigma. So what we can actually do is go and get debt to help with things like receivables and inventory. So we're looking into some asset-backed loans right now, lines of credit, things like that can help facilitate from a cash flow, working capital standpoint. And since we're public, we're also able to raise equity financing, and we're going to continue to do that. Raise equity financing for growth, hopefully access debt to help with working capital.
You had a question on the front row?
Yeah, I was looking for you to speak to your quality control measures, quality assurance, quality management systems, et cetera, et cetera.
So we recently upgraded about a year ago to NetSuite. So NetSuite ERP runs our whole company. It's cloud-based. We're adding on different modules as we speak. So the most recent module that we're adding on is the barcoding system, so we can track and trace all of our inventory. And that system is going to be fully live in our company within the next 6 months. It's going to be live in our new facility when we move here in the next 2 months, and then we're going to expand it to our satellite facilities as well. So it starts there with understanding our flow of product, understanding, having tools that can track and trace. We have a supply chain team. The head of that came from Incipio, the phone case company. So he used to run demand planning and QC for that company. So we have standards, SOPs that we have throughout our company to when every single shipment of product comes in, it's checked by our team. That is a good system, right? We obviously can catch anything that might have a defect. when it arrives at our facility. But where we're going is to be even more proactive and actually work directly with our manufacturers. So that individual that I referred to, his name's Kevin, he's actually taken off to China on Saturday. He's going to visit all of our manufacturers and overseas that we work with. Our contract manufacturers that we work with here in the States, they're upheld to ISO standards. So we have ISO facilities in California that we work with, in Colorado, and actually one in Auburn, Alabama, that we get product from. So what we're trying to do is push that upstream so that we're actually QCing that product ahead of time. Some of our new manufacturer that we work with has actual cameras that take pictures, photos instantly of the product as soon as it's ejected from the mold, and can identify anything that's wrong with that quality of that product on site, and that product won't even leave the manufacturing facility if it's not perfect. So we're trying to get better and better at that. We understand QC is a big part, and especially when you're in a compliant marketplace, one of the things we've also been great at is getting all of our products certified child resistant, and we work with reputable labs that are upheld to CSPC standards, that when these products are tested with children, that they're recorded, and then we take that data and we use it to measure at our manufacturing plants and make sure that it's replicated.
So some of your suppliers are ISO certified, but
Yes.
you're not.
We don't do any manufacturing, and no, we're not.
Yeah. You don't have to manufacture the ISO, but that's a different
Yeah.
thing.
Anybody have a question? So, go ahead.
When you talk about the M&A strategy and your ability to use your currency, when you're setting terms with your acquisition targets, what kind of lockups? I guess it's probably negotiated, differently
Yeah.
each transaction, but just if you have like an example maybe with, the last one you did with CMP or something.
Absolutely. So yeah, that's a great question. Obviously, Ben, this is his background, structuring these deals, and when we're looking to make acquisitions, if it's something where we're going to be buying all the assets and we're not going to retain any of the staff, obviously things like lockups are less important. If it's something where we're relying on the existing team to continue to drive growth, we want to make sure we're structuring it to where they're highly incentivized. So, for example, the CMP Wellness acquisition that we did, we structured it to where the stock was locked up for 12 months. There was a 12-month leak-out period after that, where they could sell a very minimal amount of shares, and then they become fully unlocked at the 2-year mark. We also structured it to where they had a 1-year earnout. So the idea is they're locked up throughout their whole earnout, so they're highly incentivized to hit the maximum earnouts that they have and drive more value to their stock. And then that gives us also a year during the leak-out period where now we can make sure that we're fully cross-integrated so that if they leave at the 24-month mark, it's not going to hurt us. So that's how we structured that deal. The other deal we did, the rollable deal, we issued that. We have that structured to where we're issuing stock in 3 tranches. So it's restricted stock, restricted for 6 months per Rule 144. And we have it structured to where they received an initial tranche upon closing. They received their next tranche at 6-month mark if the revenue numbers are being hit. And then they receive their final tranche at the 12-month mark, again, if the revenue numbers are being hit. And all of those tranches have a 6-month lockup. So they're, in effect, locked up on a portion of their stock all the way up to 18 months.
And is the idea when you're looking at various targets, like you said, you just want to have kind of a synergy where you don't currently sell into that particular market, or you don't have that book of business, but then you essentially cross-sell your products with that. I mean, is that kind of an override?
Yeah, I think it goes to our growth strategy: new products, new markets. So if we can make an acquisition, for example, like Rollable, that has a proprietary product that's new, that we know we can leverage across our distribution channels, that's something that might be attractive to us. Or someone like CMP Wellness that has, somewhat of a new product. It's a product we were already dabbling in, but we weren't doing it as well. But they basically had a whole new market, right? A whole book of business that they were selling to that we weren't. Then that was extremely attractive to us as well. So that's kind of the 2 main things that we look for. And again, they have to be ancillary and kind of fit with our overall strategy as well.
How do you acquire new customers?
Well, as I mentioned, we do have an evangelical sales force that's actually out on the ground. Every single rep that we have in the field, again, these are 6-figure type reps. They're high caliber sales reps. They're supported by an inside sales staff. So, for example, our sales reps that are up here in Northern California, our sales reps in Southern California, and our sales reps, we call them territory sales managers, out in Nevada and Arizona. they're all supported out of our California office. So it's a 1-to-1 ratio. They have a sales support staff that's actually there prospecting, setting them up with meetings. We have our marketing team. It's ran by Ryan here as our head of marketing. We have integrated software where we actually can take all the leads that we get online or through any of our marketing, email campaigns, et cetera. As soon as the lead comes in, it's actually geo-routed directly to the territory sales manager that's in charge of that region. And it's tracked in our NetSuite CRM system so that we can actually see and make sure that these leads are being followed up on. We can track the status of these leads, and we can mark them close won or close loss.
I had a quick question.
Yeah.
You know, people tend to view you guys as a product company.
Mm-hmm.
I know that you are, but you're also a service company. What are you guys doing to build your services, like custom labeling, things like that?
Yeah, so I think, our services kind of start with the idea of customization, right? And then what we can actually do to layer into help there is from the design side, we can actually we can get folks that are, don't even have a logo, we can help them create that. But most of the time we're dealing with more sophisticated people. So it's really about taking their artwork, putting it into our die lines, getting it printed either directly on the package, if it's a glass jar, something like that, we can screen print. We're doing some other thermal printing kind of on a limited basis, but a lot of it is labels where we can actually print the labels, and then folks say, hey, you're selling me labels and bottles, can you just put them on for me? So now we're doing a lot of labeling services where we're actually applying the labels for our clients. So that's most of the services that we're offering. We're doing some regulatory consulting as well, more so around packaging, and that's kind of free of charge where we're just trying to educate them on what they should be using. And we have people that are trying to scale across multiple states, and their ideal situation is a one package that fits all, but that's unrealistic. So we're kind of coaching them into how their brand can be consistent across different packaging mediums in different markets, but still have a unique and similar brand feel. So that's some of the kind of consultative services that we offer.
And then I had another one about, it seems like there's a lot of opportunity out east, and you guys obviously aren't physically out there yet, but you're covering it. I'm just wondering, is Massachusetts going legal a game changer for you guys in terms of finally there'll be enough demand that it makes sense to open a East Coast facility?
We're hoping, yeah. So when we look at our 2-year strategy, we look at expanding to the East Coast ahead of or coinciding with adult use legalization getting kicked off in Massachusetts. However, that's a moving target, as we've seen. They've already pushed it back from an anticipated date of January. They pushed it back really early on to now July of 18. Now we're seeing some data that's saying that cities are pushing back, wanting to ban it. So it might not even be effective if it does get rolled out. So we're monitoring that closely. For us, the East Coast is as a whole is obviously a big region, but gets unlocked when Massachusetts goes live, because now you're going to have a situation where people are going to be driving to Massachusetts to purchase their cannabis legally if they're 21 and older.
Legally, but not
Not take it home legally, but let's be honest, people are going to do that. And what these other states are going to realize is they're in a situation where they're, A, not preventing cannabis from entering their state because it's flowing over the border, but B, they're not getting any of that tax revenue. So we're seeing states already push to put regulation in place, Vermont, Rhode Island, Connecticut, some of these surrounding areas, that it's just going to be silly for their residents to be building schools in Massachusetts, to be funding pension programs in Massachusetts, when they could be doing it easily in their own state. The support's there from the voters. So it's going to be a really catalyst for that whole Northeast to light up once Massachusetts gets their adult use program in place.
Gating factors, because right now there's just a limited number of suppliers in the medical markets, and it doesn't make a lot of sense to get in front of that until there's more scale. Is that the right way to say that?
Yeah, I mean, certainly if we were a large Fortune 500 company or even a Canadian listed company, we could go raise $100 million, we could be everywhere at once, and we could be losing money in that region and no one would care. But we try to grow profitably, we try to grow smart. And so when we look at expanding that region, we want to get a little bit more size and bulk to that market, especially when we're weighing it against dollars spent on the East Coast versus dollars spent on West Coast. Right now, we could spend more money to penetrate Northern California, which for us is a relatively new market because, again, the dynamics are shifting in California, whereas, for the last 7 years since we've been operating, cannabis has been brought from Northern California to Southern California in wholesale form. It's been purchased by the dispensaries in bulk, and it's been packaged at the dispensary into things like bottles or jars. That's changing with the new regulation. Everything's going to have to be pre-packaged. The branding is not going to be at the dispensary level. It's going to be at the grow level. So now we have this whole market of growers and, you know, all up here in Northern California and Humboldt County and Sonoma County that are going to be buying packaging for the first time. So that's where our resources are better spent right now and focusing on our backyard and a market that we know and understand, and we can get in front of these guys early, and we know that's the next market coming online. So we look at every dollar we kind of take away, you know, to spend elsewhere is a dollar we're not spending in California, which is going to be our biggest market. But again, if the capital situation improves, which we believe it will at some point next year, I think there's going to be more investor interest in U.S. cannabis as, you know, the session scare or the session depression, as we call it, kind of goes away. And then as some of these big markets kick online, you know, people are going to start to again put their money into cannabis, and there may be an opportunity for us to raise more accretive capital and use that capital to expand quicker to some of these markets that we're currently not spending a ton of money to penetrate right now.
Go ahead.
So if the market right now, if the growers now becoming the brands, right, which means they will need to now interact more heavily with dispensaries, right, than before.
Or distributors.
Or distributors.
Yeah.
So how do you see that play? How do you see that that basically supply chain play?
Yeah, so I see it as, you know, you look at the alcohol industry, it's in California, it's mandated that they work with a distributor. I think even in cannabis where it's not going to be mandated, I think most people will find it easier to work with a distributor. So most people will go that route, especially the smaller people. It's just not going to make sense to invest in your own distribution because there's going to be a lot of red tape around, you know, the type of trucks you have to use, the type of security infrastructure you have to have. Everyone can get a distribution license to self-distribute if you're a manufacturer or a cultivator, but does it really make monetary fiscal sense to actually put that distribution license to work? I don't think it will. So a lot of the smaller guys are going to probably work with distributors. A lot of the larger guys that already have massive distribution, they may end up self-distributing, but I think from, you know, a standpoint of, you know, you look at the alcohol industry, it's very efficient. You're going to have, you know, thousands, very fragmented, you know, on the production side, cultivators and producers. You're going to have thousands of retailers or delivery services out of retail locations. The middle point is going to be a lot thinner. There's going to be probably, you know, alcohol, I believe there's about 50 distributors. There's probably like 3 or 4 you ever heard of, you know, Southern Wine and Spirits. So I think that's how it's going to be for cannabis. There's going to be a dozen or so distributors that really dominate that middle point of the supply chain and help aggregate the fragmentation on both sides, on the grow side and on the retail side.
There will be a lot more than brands if you compare that to the alcohol market, right? Because it will be a brand.
Well, that's a good question. So in theory, right, each grower could be a brand, but if it costs you a lot of money to market and to brand yourself, it may make more sense to consolidate and essentially white label under one brand. So if all of us in this room all had a 10,000 square foot grow facility and we all grew the same strains because we all shared, you know, mother plants or clones, it may make sense for us to all aggregate our product under one brand. And now when we spend an advertising dollar, it's a lot more powerful because we have more volume behind it. So that may happen as well. And I think the distributors could help facilitate that. But again, it's, you know, it's just my speculation. I don't know how it's going to play out.
And Nick, I want to thank you and remind you, I think you're on a panel in 5 minutes.
10 minutes, 10 minutes. Thank you guys for coming. I appreciate it.